Good morning. Welcome to the 102nd Annual Cattlemen's Day. Stop and think about that. That's quite a legacy that we have in our department. We're very proud of it. I'd like to introduce my leader, our department head here at Kansas State Department of Animal Sciences and Industry, Dr. Ken Odie.
Dale, thank you, and on behalf of the Department of Animal Sciences and Industry, welcome to Cattlemen's Day. We're really delighted that you've decided to spend the time with us today. This is an annual event that's been going on for many years. It's an opportunity for us to both bring in outside speakers and what we hope is some very useful information for you, and also really tap into the talents of our many and diverse faculty and the work that they're doing, and you'll hear from a lot of our faculty today as well. I want to just take a moment and just share a few comments with you about our department. We are a very large department on campus here. We have about 50 faculty. Our official fall enrollment was 1,250 undergraduate students. We have a lot of really outstanding students, and we have a very strong emphasis on undergraduate education and quality undergraduate education that really includes a lot of hands-on kind of learning. We're very fortunate here to have our livestock units close to campus, and that really allows us to do a much better job with students because we can really expose them to a lot of things that we couldn't if we did not have those livestock units close to campus. We're really excited about where we're at this point in time, and today I feel especially fortunate we were able to, because of a change of schedule, we were able to get our Dean, Dean John Flores, to come over and share a few comments with you. And I'm going to introduce the Dean in a minute, but just before I do that, I want to say a couple of thank yous. We have a committee that works for most of a year in putting this whole event together. That committee is chaired by Dr. Dale Blasey and Dr. Jim Drillard, and my special thanks to them and the entire team for putting this event together. I also want to mention that in addition to today's Cattlemen's program, we do have our legacy sale at 3:30 this afternoon, so that will be up at the Stanley Stout Center. So we invite all of you to come up to the legacy sale. We hope you're in the market for some cattle. We're always interested in that. And now I want to get back to introducing Dean John Flores. Dr. John Flores came here as Dean. He's actually in his third year here at Kansas State University. Came to us from Penn State, where he was head of the Department of Food Science at Penn State, and prior to that he was at Purdue University. And John is bringing outstanding leadership to the College of Agriculture and K-State Research and Extension. And John, we welcome you and look forward to your remarks.
Thank you, Ken. Folks, welcome to K-State. Welcome to the College of Agriculture. I have a few words, not very long, but I would like to, on top of what Ken just said about the Department of Animal Science here at K-State, I want to say a few words about our college. This is a College of Agriculture that has a very proud history, and we're actually doing some really good things. We have for the 12th consecutive year an increasing enrollment in our students. We have 50% growth in just the last 7 years or so. We have increased almost every part of our activities. We have increased our teaching and education. We've increased our research. We've increased our extension activities. Our students have become very, very successful. Even though we have 50% more, we still continue to place nearly all of them. We have 97% placement. They get good jobs because they serve the biggest industry in the world. And so we're very proud of this college, and I hope you are too. We have helped many of you in the past. We're helping the state today with the biggest industry, the agricultural industry. And my comments to you are that you are in the right industry. There's going to be ups and downs, of course, but if you look longer term, what you will see is that the population growth is going to drive a lot of change. And you're probably going to hear some of that today from our faculty. But in the next 35 years, we're going to add another probably 2.5 billion people to the population. We're about 7.1 or so today. We're going to be 9.6 by 2050. 2.5 more billion people that we will have to feed. We can do it. It's going to take about 60% more food. How are we going to produce 60% more food? We don't have 60% more land to produce that food from. We have to find ways to intensify the production from the land that we have, which is actually shrinking because the population is growing. So science, technology, and everything else that we can put into it is really what we hope to use as the tools to feed the additional population in just a few years. On top of that, the demand for food is not going to be equal across the board. The demand for protein is going to be much higher than anything else. I don't know how many of you are following the latest news about nutrition guidelines and the rest, but we've went from eat less fat to eat less saturated fat to, oops, the fat is not so bad, maybe it's okay now, to eat no carbohydrates, eat no sugars, eat more protein. Now, finally, the new guidelines that are suggested, they may actually bring the regular breakfast back. They may suggest that we eat eggs and bacon and pretty hearty breakfast. And I know most of you probably knew this before, but now, you know, it's proven again, based on science and nutrition, and our government finally getting close to say that. What I wanted to finally close with is the fact that although we have to produce more protein, which means more meat, more eggs, we can do it. We have an efficient chain that we've worked for a long, long time. We can do better because we have the knowledge, we have the expertise right here in this college and elsewhere throughout the land-grant system to really work with genetics and reproduction strategies, to really help with nutrition, animal nutrition, their health and their well-being. We have the ability to do a lot of different things. We're working very hard for feed efficiency, for water efficiency, and you will hear some of that today, all throughout the day from our faculty. On the flip side, we really have expertise in really making the final product, the meat or anything else, really much better in terms of tasting, much better in terms of nutrition, much better in terms of health. So there's a lot of things that we can do, and we can do all of that in what I call a sustainable way. And I'm sure you've heard this word before, and I'm sure many of you still don't know what that means. But in my book, what it means is that we have less inputs and we have more outputs. You put less energy in, you put less feed in, you put less water in, you put less labor in, and you get more on the outside, on the other side. We're working very hard to help you and your business to be successful. We're working very hard to see that this state and the driving financial part of this industry for the state is successful not just today but tomorrow. I'm going to close with one plea, because just yesterday we heard that the state is planning to cut our budget again. And I'm here to tell you that we've been experiencing budget cuts for the last several years. If we continue to cut the budget for our agricultural experiment station, our extension system, and our educational enterprise, eventually all of us are going to pay a price. So I'm here today to tell you that if you can do something to help us or to help our elected officials understand that this is not the best way forward, I will encourage you to do that. So with that, you're going to have a great day today. You're going to enjoy your time here with our faculty and out there with our suppliers and our industry reps. Ken and the Animal Science Department and Dale have a great program for you. I want to welcome you again to K-State, to the College of Agriculture, and go Cats.
Thank you very much, Dr. Floros. Our next speakers, no strangers to us in the room here, Drs. Glynn Tonsor and Ted Schroeder, over in the Ag Economics Department. In my opinion, they are second to none in our industry, and we do so much together with them, and I'm really looking forward to hearing their comments for the coming 40 minutes or so. Gentlemen, the floor is yours.
Well, thank you, Dale. It's always a pleasure for me to be here. I know Ted enjoys this. He tolerates this tag team approach we've done the last few years. I think I've mentioned in the past, and I'll reiterate it here, is this is one of my favorite events, and anytime I get the opportunity to give a joint talk with somebody that I respect and work a lot with, it's a unique opportunity too, so it's extra nice to be here. What I think Ted and I are going to try to do with you in the roughly 40 minutes that we were promptly reminded of right there, as you do to all good economists before you hand over the mic, totally understand, is we're going to try to walk through what I would call a plane level, 30,000 foot level outlook summary, and then we're going to spend a lot of time focusing on herd expansion details. So narrowly, I'm going to try to run us through state of the land, the first half dozen slides here, and then we're going to focus on what we think are some of the key parts of the discussion on expanding the herd. And I think most of you understand probably why we're talking a lot about that today. All right, so a lot of you know I like to start with this kind of a slide. I don't aim to put anybody to sleep, but if we do, I want to get this really broad summary across to you. As an economist, I think I can describe a lot of what's going on in this industry by looking at supply and demand factors. In fact, I think I can explain lots of things in the world with supply and demand, right? Just the way I'm trained, the way I think. And I think it's important that we recognize that a lot of the story hasn't changed from a big picture perspective in the last 6, 9, 12 months. We have tight supplies, and we have a strong, historically speaking, meat-demand environment. Throughout 2014, those were pulling in the correct direction. That led to those historically high cattle prices most of you recognize. That's why some of the charts I'm going to show you in a minute. 2014 was a record year for cow-calf producers in particular. It's a pretty good year for feedlot producers as well. And in between, backgrounders and stockers depends on when you were doing this. Going forward, a lot of that same stuff is sitting here today in 2015. There's a little bit more uncertainty on demand strength, and I would assert that's one of the reasons we've had a pullback in the market since about December 1st. I'm happy to talk in more depth about that later if you want, but very, very big picture, we have a tight supply situation that supports prices. Consumers want more meat, and they particularly are willing to pay more than we thought they would for those limited beef pounds, which connects back to Dr. Flores' comments. Now, I have two slides here with lots of numbers, and I'll only partially, excuse them. You can get all these slides later. You can look at these exact numbers later. I'm really interested in the big story, and the big story is in the purple arrows, so hopefully those of you in the back can see the arrows. This is information from LMIC, Livestock Marketing Information Center, which is out in Denver. And what they do is tabulate lots of things. So there's historical information for what happened in 2014, and then there's projections for the next 8 quarters. So the 4 quarters in 2015, the 4 quarters in 2016 is what's up here on the slide. What I want to call your attention to is on the left-hand side, the commercial slaughter numbers have been coming down. Narrowly, in 2014, we slaughtered 7% fewer animals than we slaughtered in 2013. Hence my statement on historically tight supplies, right? We pulled down the herd a lot in subsequent, past years, and we realized that in fewer animals being slaughtered in 2014. As you move to the right across this chart, you'll see in the middle here, average dressed weights continue to go up. So the industry for a long time has tried to put more weight on every animal in the system, right? That's part of the reason we have fewer cows is we get more pounds on every cow in the system. Some efficiency to that, again, like Dr. Flores was mentioning. But to the far right, the net impact of that is we produced, and therefore less beef was consumed in 2014. 7% reduction in the number of animals, slightly offset by a little more than a percent and a half increase in dressed weights. We actually offered the consumer 5.5% less beef pounds in 2014 than 2013, okay? Very strong pullback in available supplies, and that's one of the 2 reasons you had those record level beef prices at the retail level that we've heard about in the news. Going forward, the arrows tell the story about how much of this is going to continue in what direction. In 2015, we're expecting another 2% decline from those already low commercial slaughter numbers, expecting us to continue to increase dressed weights, and the net impact to the far right is about another 1% reduction in the amount of beef that's produced. So consumers are going to continue to see less beef available here in 2015. We get out to 2016, those trends kind of flatten out. Now, what I want to highlight is just because they flatten out doesn't mean we have a lot of increasing going on. That just means we've stopped the decline, right? And we can come back to that more in detail if you want later. But the punchline of this would be is these numbers reiterate my general statement of historically tight supplies. This is the parallel slide that gives you price information. It's organized the same way. The first set of numbers on your left-hand side are for fed cattle. So the 5 market average was up 23% in 2014. So among the reasons that feedlot operators had a good 2014 is if you didn't hedge at placement, which I'm not saying everybody did, but for that situation, throughout most of 2014, fed cattle prices went up after you made the feeder cattle purchase, so you're actually rewarded in that story as a feedlot operator. You benefited from that. Going forward through 2015, LMIC is projecting for the year another 4 or 5% increase in prices. I'll come back to this in my very last slide before I hand this over to Ted, but the projections I put out monthly for feedlot returns there's a lot of red ink to them in 2015, and a core reason for that, and there's actually a disconnect from these LMIC numbers and what I'm doing there, is when I put out a monthly return projection, I'm using the futures market and doing some basis adjustment to that. These LMIC numbers, for those of you that can read them, are projecting roughly 160 for each quarter in 2015, and that's 10 to 12 buck premium over, depending on what market contract you look at when you look out to the board. So there's a notable disconnect at the moment between these LMIC projections and what the futures market is projecting, and we can talk about that more in Q&A if you want. I just don't want to spend all our time focusing on it. To the far right is calf and yearling prices. Back in 2014, the average price for the 5 to 6 weights in the Southern Plains was $246. So I have this habit of doing this at every talk I've given about 6 months. Everybody in the room, if a year ago you thought that average price for 2014 would be above $240, raise your hand. Not everybody at once now, okay? Yeah. I'm doing that to remind you is the market has pulled back since December 1st, but we still have historically high prices, right? And as you go throughout the entire chain, all the animals in the supply chain are worth more than they've ever been worth. Yes, we pulled back some from December 1st. I understand that. We can talk more about that if you want. But the capital investment that's involved, the amount of money you have tied up in your cow-calf herd, your backgrounding enterprise, your feedlot operation has never been higher. That's consistent with those record prices in 2014. Going out to 2015, LMIC is projecting another 20, maybe $25 increase in those calf prices, and then basically holding their own, maybe $5 off out into 2016. I would argue the reason they have that is an ongoing tight supply. We know the calf crop is small, and at least a neutral, if not positive, beef demand forecast gives you further records that's expected for calf prices. I know I belabored that. I'm going to speed this up, but I think that's important to kind of set the stage for what we're talking about. When you look specific to the cow-calf sector, most of you have seen a chart like this I shared before. It goes from 1986 out to 2015, so it's a projection for 2015. All the others are estimates for past years, and this is returns over cash cost for how LMIC attempts to monitor kind of a representative Southern Plains cow-calf operation. I want to highlight a couple things. Back in 2004, 5, and 2013, we had returns that were close to $150 returns over cash cost. And we used to look at those as the good years. And if you look at this chart, those were all higher bars than the prior years. That purple line I put there for 2 reasons, is to call your attention to it, and I made it purple because I like where my W-2 comes from, so you see a lot of purple on these slides, all right? But to give you some context on how large that 2014 bar is. The y-axis had to change on this chart, for those of you that have ever built a chart and kind of understand that. In 2014, LMIC estimates the average return over cash cost was $522 or $23 per cow. More than 3 times better than what we used to call the good years, is the reason I'm belaboring this, to give you some historical context on how good 2014 was. 2015 is still projected to be a very good year, even with a pullback in calf prices, albeit not quite as good as 2014. And we can talk more about that if you want later, but I hope that this visual gives you context on how the cow-calf sector in particular is benefiting from being the owner of a very small calf crop and a pretty favorable beef demand environment. All right, I have one slide just to call your attention to a resource. For those of you in the room that either regularly background or entertain the issue of backgrounding every year, or you're a commercial stocker, I encourage you to make use of this beefbasis.com resource. The link's on here. These slides, we're going to show you where they're at again later. But what it does is it gives you the marginal revenue, or the output revenue increase part of that margin decision. It gives you a market-based projection of that. Narrowly, you could use it to figure out what the market's saying adding 50 more pounds to a current 700-pounder would be. That's what I've mapped up here at the top. Down at the bottom, you could use it for looking forward to this fall for the next calf crop. What does the market look like it's going to reward me for putting 200 pounds on somebody else's calf I buy from them? I don't want to belabor the numbers there. I mainly want to highlight this resource and encourage you to make use of it. Everybody's own cost of doing this varies a lot. So what you need to do is take this kind of a resource. It gives you the marginal revenue part of that decision, compare it with your cost, and then you have a projection of how much you could make per head given current market expectations. This is my feedlot slide. It's my next to last one. It shows you the volatility and variability in feedlot returns going back to 2002. I built this, actually updated it with Kevin Duvetter, who's no longer in our department, This is the monthly return series I alluded to earlier, but there's a lot of important points here. I'm just going to call your attention to the 2014-2015 story. To your far right, the whole chunk of green bars, those correspond with different months in 2014. And in general, all I wanted you to see is 2014 had a whole chunk of multiple months of positive returns that we've never really seen before, and you have to go back all the way to 2003 to find a pattern where we had several consecutive months where if you're operating from a cash strategy where I pay cash for feeder cattle, pay cash for corn, take the cash price for fed cattle, which is what this mimics, 2014 is a really good year. And the main reason for that, I alluded to earlier, was fed cattle prices increased throughout most of 2014. So if you purchased feeder cattle and didn't hedge the output, you were rewarded in that sense that led to these ongoing increases. Now the story turns and becomes a little bit more pessimistic, and this is where Dr. Tonsor comes into the room, is when you look forward for 2015, so you look right of this blue line, so these become projections for closeouts throughout the rest of 2015, you have a lot of red bars and a couple of really negative red bars. Those are projections for huge losses, particularly April is the worst month here, and that's mainly because using a futures market-based approach, the market is projecting way too low fed cattle prices relative to what was paid for feeder cattle and the going rate for corn, so the margins are upside down on basically that April through August period is what's up here. Again, I can belabor more of those details if you want. The numbers are in this slide that you can look at if you're from the feedlot sector. I encourage you to pull that stuff up later, and if you have a specific question, we'll address that further. I'm going to hand it off to Ted at that point.
Thanks. I want to kind of continue and dive a little deeper into where are we going in terms of total industry size. And I think to understand where we're headed, you've got to see where we've been and how we got to where we're at and what our industry does in response to the economic signals that Glynn shared with you so far. What I've got here is this blue solid line is total U.S. cattle industry inventory. The bars here again, the cow-calf return series Glynn just had up, 1985 through 2014. Now the 2015 number he had up there also going to be another black bar that's very high according to his forecasts. What we do in this industry is when times are good, when we're making money, we soon thereafter get the signal to expand. And we build our inventories. It's a natural economic, rational decision to respond to those high returns and build inventories. And you see what happens. We build inventories up to the point to where we get sufficient supplies that really are in excess of where our market suggested we might be when we started the expansion, and we end up with prices that decline substantially. Now, we know this one was a storm of a set of multiple events that took the industry from positive returns to nearly $100 losses. We had feeder cattle prices that from 1995 to 96 dropped over $20 a hundredweight. We had corn prices because of the drought that went from $3 the previous year to $5 that year. We saw some misery in the industry. And of course what happens is eventually the industry shrinks as a response to that. And folks, during this time period now, we had in our industry an acceleration in our concentration and our loss of cow-calf producers in the U.S. We go back, we had about a little over 1 million cow-calf producers in the U.S. in 1985. You fast forward that to today and we're at about 720, 25,000, something like that. And so we've had about a 30% drop over long run. It's about a 1 to 1.2% drop in the number of cow-calf producers that are out there in our industry on an annual basis. So if you went back to 1985 and you looked around the room and you look and fast forward today, about a third of your friends that were cow-calf producers aren't here anymore. They've exited. Well, during times like this, we accelerate that exit. Not only do we have some shrinkage in the herds that are there, but we had about a 50% greater rate of exodus of cow-calf producers in the industry. So these negative returns do create pain, and they create industry exit, and they accelerate it. Now, then we shrink down, and we get to where returns get positive again, right? And in response, there's a lag because it takes us a while. We ramp up, we increase our breeding herd size, we get the calves into the pipeline, so on and so forth, and in a couple of years, we respond again. And the inventories raise, and we now have lots of animals around. Again, a natural reaction to that signal that was there. And of course, then we see we have excess supplies, prices drop significantly, and we face some losses out there. This has been the case going back to forever in this industry of seeing signaling expansion, and frankly, we expand probably too rapidly and too far, the industry as a whole, and we pay the consequences eventually that come to us from a number of things, but certainly supply being part of that driver. Now, as we look down here to the recent years, we've seen now record levels of profitability. I think the signal is about as clear and loud as it's ever been that expansion indeed is in our current set of management strategies, and we've already started. So I'm going to drill back and look at just the cow herd itself, the breeding beef cow herd itself, and explore what we're doing and where we're going. And mostly what I'm after here is thinking about where we're going and thinking about what it means for those of you in the industry who have vested capital on the line. We dropped down to the lowest herd we had had since way back in the 60s. By 2013, 14, again, low levels. Now, where are we going? Well, here's our first uptick. In response to these very high returns that we're seeing, we are indeed reinvesting and rebuilding our herd at somewhat of a moderate rate so far. What I want to emphasize here for a moment is, as you see, we have had certainly long-term reduction overall in our beef herd. We've talked about that a lot of times. We can talk more about that in question and answer. But that's a long-term trend that has been present in our industry. And part of that has been the capability to still produce lots of beef with fewer cows. The efficiency that Dr. Floro's mentioned. But there's some other things at play for sure. But something that you notice here is every time we respond to an economic signal, which is here, we had profitability that brought us there, we had profitability that brought us there, we had profitability signals that got us there. Every time we see one of those and we respond, afterwards, first of all, we only come back to levels that we've only been to typically within the last 10 years or less. We don't re-employ assets to get back to levels that this industry once was at. We only take part of those assets and re-employ them. Now that's interesting to me because it says that it looks to me like a lot of times in this industry when we have land and other assets that exit, only part of them come back. So even though we're seeing these massively high returns right now, how far back can we come relative to where we've been? And I'll give you a couple of example pathways we could go. How many of you think that as we go through this expansion, within the next 5 years, we'll get up here to over 32 million head again, which, by the way, would be back where about we were in 2008? How many of you think within the next 5 years we'll get there? Record profit levels? I don't see any hands. I don't know. I'm not yet convinced we will or won't. I'll give you a couple of forecasts here in a moment of some folks that think we might. What about 31 million? Halfway between. I'm seeing some heads shaking, some hands raising. Maybe we'll get there. I will tell you this for sure. I'm not the greatest forecaster in the world. In fact, this number I thought would be up, this 2013 number, 13-14 number, I thought would be up already. I thought it was going to increase quicker. We got there in 2015. I thought we'd get there a year ago. But we are starting to see that expansion. Well, let's just look briefly at what some of the models that are out there are saying. So before I do this, I'm gonna explode this little segment. So I'm gonna change this axis markedly, so don't overreact. I'm simply gonna show this in a much more refined graphic so you can see the trends. What I've got here is the green line is USDA's forecast. These were both made at the end of 2014. The red line is the FAPRI forecast at University of Missouri. So these are two macro level kinds of modeling efforts that are forecasting where they think at least the beef herd's going to go, the inventory is going to go. Now, again, late 2014, they're already both low relative to where we were at January 2015. We were at about 29.7 or so. Both were lower than that. USDA actually expected a decrease in their modeling efforts. By the time this plays out, USDA thinks we're going to be close to that 32. Now, what I can tell you, I may not be the greatest forecaster sitting in this room by any stretch, but I can tell you if we get to 32, we will have red bars in this industry. We will have losses unless something I can't even fathom can happen for increasing demands or something else. If we get there, we'll have some exodus. Of course, it's going to take growth to get there. But both saying somewhere between 31 and 32 as just a 5-year horizon forward expansion of this industry. That is very aggressive growth. And if it were to occur, would be one of the more pronounced growth industry rates we've seen for a long time. The signals look pretty strong. I saw most of you saying, well, maybe this red one is more feasible given where we're at and where we're going. I want to put this in context a little bit. A lot of times we hear, well, the California drought is holding us back, and indeed it is. Now, this is yesterday's Drought Monitor story, and the dark red, and even this orangish is exceptional drought, severe drought, and extreme drought conditions. We've heard that one a lot. Folks, even if we took California, Nevada, New Mexico, and Arizona, all Southwest states under significant drought situations, and they've been there for a long time, if we took all of those states collectively together and we expanded the inventory back to 2008 levels, remember the last time we were over 32 million head, if we collectively expanded all those together, we'd go to about here. We'd only add about 200,000 head. It's not about the Southwest. Yes, they're hurting, and yes, they've shrunk, and yes, severe droughts are out there. That's not going to be where this increase that we're talking about is going to happen. Look at the drought again. We hear that a lot of the drought has resided in Texas. I don't know. It looks like there's still a fair bit of that state that's under extreme and severe drought conditions. So if Texas were to turn around, Texas could easily add about 1 million head because they're about 1 million head shy right now of where they were in 2008. The industry capacity may still be there, the capability. So Texas could be a huge player in this expansion strategy. So it could occur that we could get up here if Texas could get out of their drought situation long-term enough to reinvest into the industry and carry that forward. But it's going to take things in addition to the economic signals that are here, because of the reasons I think we are buffering our expansion rates still rests back in that we are constrained from expanding at the rate that we might want to based on the economic signals because of other constraints, certainly drought conditions being part of that story.
All right, so I'm going to interject one point on top, or clarification, go further with one of Ted's comments, is yes, if Texas went back to levels from about 5 years ago, it'd be about 1 million more cows. But implicit in the way that Ted presented that would be if the rest of the country sat still, right? So even if Kansas, Great Plains, Southeast, other regions were to add some more cows, right, and Texas came back, you can get more than 1 million more, right? So you could tell a story. The stars would have to align right for it to happen, but with a large economic signal, there's a lot of effort in multiple states to expand, and Texas isn't the only one that's trying to expand, or in their case, repopulate. That's what I want to highlight. Two things I have on this slide I want to highlight for you. One is I think it's very important, and Ted alluded to this pretty hard if you were listening to his subtle points, was one of the reasons we've shrunk the herd over time was we used to have some beef demand problems in the industry. So in the 80s and 90s, there was demand challenges that sent economic signals to shrink the herd. That's important to keep in mind because as we go forward, if we reverse this tight supply story, like Ted said, if we add 1 million or 2 million more cows, right, we've removed the supply support part of that, it's going to be more evident and more apparent to everybody that demand strength is critical. Now, I would assert to you it's always critical, but you'll see it more when you no longer have the tight supply part of that story. So from a historical perspective, I encourage you to keep that in mind, and we're going to circle back to forward-looking demand stuff in a moment at the end of our remarks. At the bottom here, for those of you that are in the room that are entertaining the notion of expanding, there's a resource I want to call your attention to. It's KSU-Beef Replacement's the name of this Excel file, so it's a user-based decision aid. And you can find it. Here's where the link is. I've actually got a couple fact sheets and what I'd call a YouTube video that, you know, I recorded myself using it. So hopefully that's helpful for you. We last updated it as of Christmas Eve. Yes, I am that guy that does that kind of stuff on Christmas Eve. But, the phones were a little more quiet that day, so that worked. This is the only slide I'm going to show you about that resource because I mainly just want to call your attention to it. But I want to tell you what you get out of that to kind of bait you to use it. On the left-hand side is a schedule of values of what we would describe as net present values. And these are basically the economic value of a replacement animal that can be added to your operation. And I'm going to walk you through how to interpret this number and tell you what it means and encourage you to go use this resource on your own. The number I've highlighted down the bottom of the purple box corresponds to the year 2021, says 7 calves, and then the numeric number, or the monetary number, is 2,359. What that number means is the default at the moment from this resource is you could go out and buy a replacement heifer that you expect to give you a calf over the next 7 years. That's where the 7 comes in. And if you paid $2,359 for that animal, and if the default settings of the tool fit your operation, then you would have an expected rate of return on that investment of 7.5%. I know there's a lot of econ speaking that, so I'm going to give you a couple examples. Okay? The base scenarios assume it costs you $700 a year to run a cow. The base scenario assumes you're okay with a 7.5% rate of return being expected, and we obviously have to put in an output calf price series because that's the main part of your revenue. So I've put in the USDA numbers there. So if you kind of agree with USDA's projections, you're okay with 7.5% rate of return being expected, and you roughly can run a cow for $700, that's your situation, then you could pay $2,359 and basically get what you want from a heifer. If you have to pay $3,000 for that animal, which might be the case in the current market, then if nothing else changes here, you're locking a lower expected rate of return than the 7.5%. If somehow you could go to the auction and get the same thing for $2,000, right, goes the other way, you'd get a better than 7.5% rate of return expected. So one thing I want to highlight here is you have to go in and tailor this to yourself. So if you know you have a different cost situation or a different target investment rate of return, those kind of things, you can tailor this. But the main point of it is this will calculate what I'd call the emotionless economic value of a female, and you can have that in your head when you go to make your purchases. Now, that's the main reason I bring it up. I think it's important to recognize why somebody could actually be purchasing or why somebody might be paying $3,200, $3,400, $3,500 for replacement. If you go in and you change that cow cost from $700 to $600, you raise these net present values by about $300. Somebody that has a cost advantage can pay more. If you go in and you increase the output calf price expectations by 10%, you can pay almost $500 more. Somebody that's more bullish on future calf prices can pay more, right? So this stuff is intuitive. You can go through and do some of that sensitivity. That's what's in one of those fact sheets I noted. But you can actually tell a story under what situations is it rational for somebody to pay $3,200 and under what situations is it not.
You know, farmers are notorious for when they got cash in their pocket, they give it to somebody else, or they buy something from somebody with it, right? We don't sit on it very much. Look at our crop producers. As they made record returns, what did they do? They put that money into either land, in a lot of cases, or new equipment. And you see it across the countryside, the magnitude of new equipment out there. What I want to caution a bit is, as they put into new equipment to spend all these profits they were making, and prices started to come back around and they have depleted working capital. Today, some of those folks are sitting out there, yeah, they avoided paying taxes a few years ago, but the working capital constrained a little bit. And as we think about expanding, and relative to Glynn's comments on the value you can pay for replacement animals to bring back into the herd, recognize that we have had, and you've seen this, it's part of the reason your returns are so high, we have had a 40 to 50% increase in the cost of that replacement animal that we're putting into the herd relative to where we were just 2 years ago. Now, I want to step through that a little bit with you and give you some idea again, historical perspective, and look forward to what we are doing in the cattle industry relative to increasing our capitalization, increasing the amount of investment we've got out there on our farms and ranches. This is the number of animals, number of cows that we added to the breeding herd each of these respective years when we grew. So in 1981, we added 1.7 million head to our herd from the previous year. That was the expansion that occurred in response to some very positive returns just a couple of years before that. In 1996, responding to the returns we were seeing in the early 90s, we added 1.2 million head to the herd that year alone, 3.7% increase. Here in 2015, relative to the previous year, we added 608,000 head. Now, a couple things. First of all, what you'll note is that when returns are good for a little bit, we don't do all the expansion typically in 1 year. The expansion occurs across a few. So as you all raised your hand, you all told me that you think this number is going to be blue again this year. If we're going to get to 31 million head, it's going to have to grow again a little bit further. I'd agree. I think it's going to continue to grow. I don't think we're done yet. That continued growth is going to come at a very expensive investment rate. And let me give you some perspective on that relative to those other two expansion sequences we went through. So this is just looking at those years where we had large expansions. 2015 still smaller than those in terms of number of head. Maybe 16, maybe 15 into 16 will be another big number, and we'll see where it's at. But all I did here was just want to give you a sense for the magnitude of dollars we're putting into the industry in investment in animals. These are the nominal prices. It's a price, it's the check we actually wrote if we were buying heifers, or it's the opportunity cost if we're saving our own at a nominal rate. So today we're spending about 4 times what we would have in 81. We're spending about 3 times what we did in 94 for that expansion, bringing those heifers into the herd. I deflate those by a producer price index, and the main point is these heifers we're adding, we're bringing them in at current dollars at a 50% higher rate investment cost just for the purchase of the animal, or the opportunity cost of not selling the animal, than we did the last time we had a major expansion, after adjusting for inflation. Now add to that the $10,000, $12,000, $15,000 bulls that we're putting with these in some circles, and we are increasing our investment very rapidly, well beyond $1 billion. Okay? Sink that number in a bit. That's the magnitude of the cow-calf sector added investment in 1 year alone, and we're going to see that number get much larger, in my opinion, the next year. That's the rate of capitalization we are taking this industry. Now let me go one step further and look at the feedlot, and then I'll turn it back to Glynn here. Folks, the feedlot sector, even a more dramatic increase in capitalization. This is the amount of cost in inventory just to put 150 head of cattle into a feedlot. So during the early part of the 2000s, you had to have about $100,000 between your own money that you're putting in equity and somebody else's that you're using to purchase those cattle, put them in the yard. About $100,000. You can see we have stepped up. You have to have $250,000 today to put 150 head of cattle in the feed yard. That's just the inventory cost of the animals alone. This industry is very rapidly becoming immensely capital intensive, not only at the cow-calf sector, but at the feedlot sector as well. What's that mean? Well, as you go through this, the signals to expand are still here. They're going to keep occurring. These are long-run decisions, but I expect them to continue. But it's coming in at a very expensive rate. What this says to us is you better watch your working capital very carefully. Don't do what some of the crop producers do and invest all of the cash so that when times go back and the numbers become red, you are part of that industry segment that has to exit. I think when times are good, we relish and we should enjoy them, but keep in mind that's when you need to build working capital for when the times are not going to be as good. Risk management becomes critical when you have this kind of capital expense in our industry. And it's not just price risk management. Price is obviously part of that story. But you have way more expensive animals out there. The fences better be a little better than they were before. Maybe gates locked. You know, we've got that issue going on. You've got to have animal health at an accelerated, higher, more intense level than before because the loss is now real dollars. Not that it wasn't before, but it's deeper now. The entire strategy of managing risk across the operation as a whole so you can be here tomorrow and be here next year, that's what we're talking about. When you put capital in at this rate, you've got to be able to manage that capital much more carefully.
So I want to, the last point that was on Ted's slide, he didn't mention it, but I'm going to take it and run with it from there, is the industry better hope for and recognize the importance of beef demand, right? If you have that kind of capital tied up, and we all agree we're going to start eroding the support that comes with tight supplies, it's going to be more evident the role of beef demand. Said that a couple times, but I want to highlight a little bit further. But I also want to kind of clarify why 2014 was so good, not just from a supply perspective, but from a demand perspective. And that's the point of this slide. So one of the things I try to monitor is trying to measure demand strength over time, something called a demand index. I don't want to belabor exactly how that's built. We can deal with that in Q&A if you want. But the numbers up here basically highlight that the last 4 years in this annual index, we've had year-over-year beef demand growth, which is a great thing. Consumers have seen more value for the beef products, been willing to spend more than we expected them to on a per pound basis, and that's more money coming into the industry that's facilitated those very high heifer prices and so forth that Ted just showed you about. We would have higher prices just from a supply perspective, but we wouldn't have as high as we did if we didn't have demand strength. Both are pulling in the right direction for that. To give you some context of what's underneath that and why I'm saying that, let's dissect 2014 narrowly. In 2014, the average U.S. consumer consumed 3.7% less beef than they did in 2013. Again, that's mainly because we produced less, there's less available, therefore less was consumed. The actual all-fresh beef price, once we adjust for inflation, was up over 11% in 2014 compared to 2013. If I was sitting here today and I looked back at those prices and they went up 6%, then I would be sitting here today telling you demand didn't increase. That price increase perfectly matches the supply reduction that occurred. Otherwise, given the reduction in volume that was available and therefore the reduction that was consumed, I expect prices to go up if demand is flat. And the exact amount that I expected it to go up in that story was 6% increase in prices. When I observe prices go up more than that threshold level or expected level, then I know demand increased. The public was willing to pay more for those fewer pounds than my spreadsheet approach suggested they probably would have, right? And the only reason that can happen is if demand increases. And in geeky econ speak, that means the demand curve moved, not just the supply curve, right? We're talking about the supply curve's been shrinking quite a bit, but if the demand curve moves in the right way too, which was the case in 2014, both of those gave you higher prices. The reason this is germane for the last couple points Ted made is going forward, here in 2015, 16, and forward, as we reduce the support that's occurred from tighter supplies, it's going to be even more important that we have stable and expanding beef demand, both on the domestic front and foreign, to facilitate maintaining, if not growing, prices further. All right, so let's try to wrap this up to stay close to our 40-minute target. Very broadly, connecting back to where we started, I would suggest that the cow-calf sector is set up for a very good 2015. You're probably not going to set the record you did in 2014, but that's probably okay. For those of you that have, more historical context than me, you understand just how good 2014 was compared to typical years. So 2015 is still going to be a very good year. For the stocker backgrounder side of things, I would call it as okay. There's going to be a lot of money tied up there as well, and those margins probably aren't going to set a record in 2015. The whole issues of capital and risk management that Tev's alluding to, both on expanding the herd as well as feedlots, they apply there also for the exact same reasons. And then finally, I very quickly showed you a lot of red ink being projected for feedlots in 2015. I can belabor that more if you want, but I'm concerned about returns here in 2015 for that sector. What are going to be the keys to profitable expansion? Just summarizing the points that Ted and I've made, it's going to be critical that we continue to expand both domestic and foreign beef demand. Hopefully you're hearing that loud and clear. It's going to be critical that we continue to have production efficiency gains, and I should make that even longer, just call it efficiency gains, because it's animal health gains, it's gains on every front to get more out of every one of those animals that cost us more to put into the herd. That's going to be critical. It's going to be very important that we rethink and probably implement more risk management strategies. And then finally, something we haven't explicitly touched on, but some of you have heard me talk about this in great length, I think it's going to be more important that the U.S. beef industry as a whole kind of pulls together in the same direction better in the future than it has in the past. As we continue to have more and more money tied up in this industry, what I would call within industry fighting is going to cost more than it used to in the past. Shoot yourself in the foot kind of things are going to hurt more when you have more money tied up, and I would encourage us to play nice in the sandbox a little better than we've done in the past. My last slide, I told you we were going to show you where this information's at. On our agmanager.info website, you can find these exact same slides. I highlight that for two reasons. One is I know not everybody can read the numbers. That's not really the point of this talk, but you have access to them. The second is several of the charts that Ted and I have shown you, we update them over time, right? So if one of them is appealing to you and it's 6 months before you see me again, you can go to this website and see a more frequent or more updated version of that. And I encourage you to make use of that resource. So with that, Dale, I think we have a couple minutes if anybody has a question.
Any questions?
The retail price that beef is now, what effect has that?
So the question was, at the current retail beef price, what fed cattle price level would that support? Well, I can make this a really long answer and say, what kind of margins have to be there for packers and retailers and so forth. But in general, I think what you're fishing for is fed cattle prices probably would be higher than they are on the board today, given retail prices. But I'm not sure they'd be higher than what cash price is. So there's, again, depending on when you peg this, there's a $5 and sometimes $10 disconnect between cash fed cattle prices and the futures board. I'm not sure that cash cattle are way disconnected from that, given retail price. There's room for them to go up a little bit more, but probably not as much as most are thinking.